What if the UK house building industry is already dead, and we're only now being told when the funeral will be? That's the question quietly circulating inside boardrooms, banks, and government departments, as new internal data paints a picture far darker than anything admitted publicly. Executives are no longer asking if a collapse will happen, but when, and the date keeps coming back the same. 2026. Not because of panic, not because of headlines, but because the numbers simply stop working. Confidential modeling, leaked briefings, and hard financial limits are converging toward an outcome many insiders now describe as unavoidable. What makes this moment unsettling isn't fear, it's calm. A calm that comes when everyone involved already knows the ending. Builders are still operating, banks are still lending selectively, and politicians are still making promises. But beneath the surface, the industry is behaving like something already terminal. And once you understand why that conclusion has already been reached, it becomes clear that this isn't a warning about the future. It's a report on a collapse already unfolding. One of the first warning signs didn't come from falling prices or rising repossessions. It came from absence. Tens of thousands of property listings didn't sell. They were simply removed, not upgraded, not relisted, not marked down, just gone. When homes sit unsold for too long, they start telling a story sellers don't want told, because stale listings signal that buyers are pushing back. And instead of letting that story play out in public, portals and agents quietly erase the evidence. That alone tells you confidence is fragile. At the same time, agents were privately instructed to stop advertising real achieved prices, replacing transparency with vague optimism. Banks, meanwhile, tightened access to repossession data, choosing silence over disclosure. Everyone is still insisting the market is resilient, but their actions say the opposite. This isn't what stability looks like. In a healthy market, sellers compete for buyers. In an unhealthy one, sellers compete to hide weakness. And when that happens at scale, it usually means the people closest to the numbers are trying to buy time. But time is exactly what the market doesn't have. Because pressure isn't easing. It's building somewhere far more personal, far more unavoidable, and far more explosive. Behind every stalled development and half-finished site sits a construction loan. And collectively, UK banks are holding roughly £93 billion tied directly to builders continuing to build. These loans aren't passive investments. They rely on constant activity. The moment construction slows or pauses, covenants tighten, interest escalates, and loans begin to fail. That's why this collapse isn't gradual, it's synchronized. When builders stop building at scale, banks don't face isolated losses. They face a systemic hit. Yet there's no public panic, no emergency meetings announced, no visible alarm. That silence is telling. Banks aren't assuming the market will recover, they're assuming intervention. The expectation is that construction is too embedded in the economy to be allowed to fail openly, even if it has already failed in practice. Lending has quietly frozen, refinancing terms have hardened, and penalty rates have replaced growth capital, all without official acknowledgement. Credit markets are signaling distress long before headlines do. And the reason banks are preparing rather than reacting is simple. They understand the underlying economics of housing construction no longer work. Once you see that mismatch clearly, the inevitability becomes impossible to deny. Markets rely on balance. Some sell, some buy, and prices adjust gradually. But when large numbers of people are forced to sell at once, that balance disappears. What's emerging now is a synchronized rush toward the exit, driven not by panic yet, but by necessity. Homeowners whose fixes are ending are listing properties into an already cautious market, competing with others facing the exact same deadline. Buyers sense desperation and step back. Sellers hesitate, hoping conditions improve, and the market freezes. This is the most dangerous phase, because nothing clears. Transactions stall, prices stop moving, and stress builds quietly behind the scenes. Mortgage brokers are seeing applicants who would have sailed through approvals a few years ago now rejected without negotiation. There's no flexibility, no workaround, no second look. That creates a backlog of forced decisions, not voluntary ones. And forced selling doesn't negotiate, it waits until it breaks. In the past, this is where international money would step in, spotting opportunity where locals saw risk. But this time, that safety valve is gone. The clearest evidence that construction has already stalled isn't found in sales data. It's found upstream. Brick manufacturers are operating far below capacity, suppliers are closing branches, and logistics networks are shrinking week by week. These are not temporary adjustments. They're responses to demand that has vanished. Construction sites still appear active, but many are operating with minimal crews, not to progress efficiently, but to avoid triggering loan defaults tied to inactivity. Subcontractors who survive on cash flow rather than balance sheets are exiting first, refusing delayed payments and unviable contracts. This creates the illusion of ongoing development while real productivity collapses underneath. The industry looks alive because it hasn't officially stopped, but functionally it has. And this quiet slowdown is more dangerous than a sudden crash because it drains resources while offering no path to recovery. Even if financing returned tomorrow, the next problem would immediately block any restart. The people who actually build houses are no longer there. Build to rent was sold as the future. Professionally managed housing, stable yields, long-term vision. It worked when money was cheap and demand felt endless. But the entire model rests on full buildings and premium rents, and both assumptions are failing. Occupancy rates are slipping as renters leave expensive cities, return home, or opt out altogether. These developments were financed with massive loans at low rates, and refinancing them in today's environment is a completely different story. Rents can't be cut without admitting the numbers don't work. Assets can't be sold without locking in losses. So the losses pile up quietly, month after month. And when defaults begin, banks won't just be holding paper losses, they'll be holding physical buildings with no easy exit. That shifts risk from developers to the financial system itself. But even that isn't the biggest unresolved threat sitting inside the market. That honor belongs to something millions of homeowners thought they understood but didn't. Leasehold was marketed as ownership, but in practice it's something very different. Owners are now discovering that what they bought wasn't control, it was exposure. Service charges are surging, ground rents are escalating, major works bills are landing without warning. And buyers are walking away, not because the properties are bad, but because the structure is toxic. Once the market collectively decides an asset is uninsurable, unmortgageable, or unpredictable, it stops functioning as housing and starts behaving like a liability. Prices collapse, not gradually, but suddenly. Flats that once symbolized security are now trapping owners who can't sell, can't refinance, and can't escape responsibility. Multiply that by millions of properties, and you're no longer talking about a niche problem. You're talking about systemic paralysis. And sitting above all of this is a central bank with no clean solution left. Rates need to stay high to control inflation, but high rates are crushing housing. Cut rates too soon and inflation resurfaces. Hold them too long and the property market implodes. Every option carries consequences, and none of them are mild. Public messaging suggests patience and balance, but behind the scenes, contingency planning has begun. Stress tests assume orderly declines, rational behavior, and functioning liquidity. But this market isn't behaving rationally anymore. It's constrained, distorted, and overloaded. The fear isn't a slow decline. It's a sudden loss of confidence that spreads faster than policy can respond. And even if monetary relief arrived tomorrow, it wouldn't solve the final structural force pressing down on the market. The UK isn't just facing a financial imbalance, it's facing a demographic one. Household formation is slowing, birth rates are falling, the population is aging, and older owners don't buy, they sell. Over the next decade, millions of homes will come onto the market through inheritance, downsizing, and necessity. At the same time, hundreds of thousands of new builds are still completing into a market where affordability is already broken. Supply is rising, demand is constrained, investors are leaving, buyers are cautious, and banks are exposed. This isn't fear-mongering, it's arithmetic. When too many sellers chase too few buyers, prices don't gently adjust, they reset violently. The only reason this hasn't exploded yet is because everyone is pretending time will fix it. But time is doing the opposite. The reality is we're not heading toward a housing collapse, we're already inside it. It's just moving slowly enough for denial to survive a little longer. And when that denial finally breaks, it won't be years before the impact is felt. It will be weeks, maybe less. Because panic doesn't wait for permission anymore. And once gravity reasserts itself, the only question left is who was standing underneath when it did.